Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I am Muralidhar Swaminathan. Joining me on the show today is Mihir Kaji, CEO Alpha Investments. Mihir is from Surat. Mihir, welcome to the show. Thanks for joining us.
Thanks for having me.
Mihir has been tracking markets and mutual funds for almost 12 years now.
Yeah,
almost 12 years. And Mihir comes from Surat. Surat, which is the heart of equity markets within Gujarat, one of the important markets contributing to the capital market, as also now there is a transformation happening. And meanwhile, let me also try and tell our viewers that we are now introducing fund advisors from different parts of the country. And as always, let's bring to you the winners and losers of the day. Every day we have been bringing you the top funds in equity category. While it is important to stay invested for a reasonable period of time to make money, it is also important to track fund performances on a daily basis. The reason being that you should know whether your fund is making money. Has your target been achieved? Is it right time to increase, hold, sell? Because remember, there are a large number of schemes and each investor has a different goal, different time frame, different plan. So, do not go blindly by if someone says that you stay invested for 15, 20, 30 years. No, that is not the way to do it. You may have invested over the last 5 years. Your target might be that it should double. If your target is achieved and if the money has to be used for a specific purpose, you need to take a call, which is why we help investors by bringing in winners and losers of the day. As you can see, lot of thematic funds continue to do very well in a market where the focus these days is on consumption. Consumption is the theme as far as the budget is concerned, which is why you can see a lot of consumption related thematic funds coming up on the screen. Now, let me get back to Mihir. Mihir, Surat is a very interesting place as far as capital markets, investing in different asset classes is concerned. The sense I got when we did 2 investor camps in one in Surat and one in Ahmedabad is that investors there are moving away from risk, moving to mutual funds. Now, there is a general belief that investing through mutual funds help you not only prosper, also cut losses. What is your ground experience?
Yeah, very similar to what you said. You know, Surat and Gujarat in general has had a very deeply ingrained equity culture. So far, you know, people used to do it themselves by going and investing into stocks themselves based on tips or based on their own research. But what has been seen over the past few years is that they are finally realizing that, you know, unless this is a full-time job and unless you have that kind of expertise to analyze each of the companies yourself, it's better to go through the mutual fund route. You are still investing in equities, but you are, you know, giving your money to some experts who know what they are doing.
Exactly.
And you make a portfolio of those kind of funds, and that's what we are seeing.
Right.
Also, I am seeing a lot of maturity in the investors lately. You know, earlier on we used to see a lot of volatility even in their emotions with the market. You know, so if the market goes up, there is a huge inflow of money coming in. When it goes down, people would get nervous and sell. These days what we are seeing is a steady inflow of SIPs, STPs, and that is, you know, thanks to MFI, thanks to all the mutual fund distributors and thanks to campaigns like Mutual Fund Sahi Hai. People are finally realizing the importance of financial planning and going through this process of planning and giving their money to experts.
Absolutely. You know, this transformation that is happening for retail investors, this is a very important lesson that one needs to draw from Gujarat, the core supplier of money for equities in this country for, I don't know, as long as 50, 60 years that we have seen. It's as long as the history of the capital market itself. The transformation is happening there. People are moving from tips to SIPs. You know, on that note, let me take the first query. Surya Pradhan from Bhubaneswar has mailed us his query. He is 34 years and he is investing through SIP 12,000 rupees each in HDFC Mid Cap Opportunities Fund, SBI Emerging Businesses, ICC Pru Blue Chip, Franklin India Smaller Companies and Reliance Multi-Cap Fund. His goals are to accumulate 20 lakhs after 12 years for his daughter's education, 30 lakhs after 23 years for her marriage and 1 crore after 30 years for his retirement. Very well planned, you know, 15 to 20 years horizon. What's your response?
Absolutely. So first of all, I would like to congratulate Surya for realizing the importance of financial planning defining specific goals and then building a portfolio of investments to help him achieve those goals. Now, he has said that he is investing 12,000 rupees each into these 5 funds, so he is investing 60,000 rupees. I am not sure if he means that he is investing 60,000 per month or per year, but I am going to assume that he is investing 60,000 per year.
Per year, yeah.
So, assuming a post-tax compounded annual return of 13-14% on his investment, and considering the investment and redemption timeline that he has specified, I think he needs to invest a sum of rupees 1,30,000 every year, which comes to around 10-11,000 per month. So yes, he needs to increase his investment amount a fair bit, and if he continues with this investment of 10,000 or 11,000 per month for the next 20 years, he would be investing around 25-26 lakhs, and what he would get in return is that he would get 20 lakhs for his daughter's education 12 years from now, 30 lakhs for her marriage 23 years from now, and 1 crore for his retirement 30 years from now.
That's achievable.
That's achievable. And as for the funds that he has in his portfolio, I think considering his age and investment time horizon and risk profile, which I assume he has, I think most of his funds are good enough. I would just recommend that he consider switching from the Franklin India Smaller Companies Fund into either HDFC Small Cap Fund or Reliance Small Cap Fund via SIP or STP route.
Right.
And another thing he should consider is that as he grows older, maybe around the age of 45, he can switch a part of his portfolio into aggressive hybrid funds, which are a mix of equity and debt. Maybe around the age of 50-52, he can put more of his portfolio into conservative hybrid funds. And then maybe 2-3 years before his retirement, he can shift a majority of his portfolio into debt accrual funds.
But,
and he should be fine.
But don't you think that debt is even more riskier than equity?
No, but he is 34 right now. When he starts doing this at 45, 50, 55, he would already have a good enough cushion of returns.
Okay.
And then just to decrease the volatility as his age goes up, that is why he should be considering this.
Right. The next query is Pradeep Chatterjee, who is on the line from Kolkata. Good afternoon, Pradeep. What's your query?
Good afternoon. Greeting from Calcutta. I am a senior citizen.
Yeah.
So my question is I have invested lump sum 20 lakhs in ICI Prudential Balance Fund and 2 lakhs in ICI Blue Chip Fund.
Okay.
So my question is that fund is not giving good return for last 2 years. I have invested 2 years back. So shall I redeem it and put it in a bank fixed deposit, or I will continue it for? I can keep another 2-3 years, no problem. That is my question.
Right. 2 years back he invested. He wants to know, I think it's not doing good now. What's your call?
So Mr. Chatterjee, I understand your dismay. Assuming you invested 2 years ago, let's say in January 2017, you might be looking at negative returns of 2-3-4% in this fund. Now, you need to realize 2 things here. First is that the fund that you have invested in is an aggressive hybrid fund, which puts 65 to 80% of the money into equity and the rest in debt. That is the first thing. The second thing is that you invested lump sum, which means that you inadvertently ended up trying to time the market, which, as you can now see, is easier said than done. Now the fund itself is a good one. It's actually one of the top performers in its category, and there is nothing wrong with it per se. Having said that, considering your age, your investment time horizon and a conservative risk profile, I would advise that you do not stay invested in this category of funds. I would recommend that you exit from this fund and then put half of that money into debt funds such as Aditya Birla Corporate Bond Fund, HDFC Corporate Bond Fund and ICICI Long Term Bond Fund. These are all funds which invest predominantly in debt, and the other half of the money you can invest in conservative hybrid funds such as HDFC Balance Advantage Fund, Reliance Balance Advantage Fund and ICICI Balance Advantage Fund. So what this will do is that it will predominantly put your investments into debt predominantly with a little bit of equity to spike the returns. And the money that you invest in these debt funds, if you stay invested for the next 3 years, you will get the indexation benefit on them. And if you hold this allocation for 3 years or more, you should be able to get a low double digit kind of return. And also my advice would be that the money that you put into the hybrid funds, put them through SIP or STP route, so that you can take advantage of any volatility that may come up around election time this year. So
right, all the best with your investments, Mr. Chatterjee. And before I go to the next query, you just saw the news flashing on your screens. The RBI's monetary policy will now be announced at 11:45 a.m. on Thursday and not at the customary 2:30 p.m. The new governor has changed the timing. The timing is now at 11:45, and that will be followed by a press conference at 12 noon. We at BTVI keep bringing you news that is relevant to you. We keep breaking the news always first. So remember, on Thursday to tune in before 11:45 and not wait till 2:30. Tune into BTVI to catch all the special coverage on the RBI policy, to expect if at all there is a rate cut that would be there. Let me get back to the mutual fund query. Sandeep from Bengaluru has mailed us this query. He is investing through SIP since 2017, 2,000 rupees each in ABSL Equity Advantage, ABSL Mid Cap, HDFC Equity, HDFC Mid Cap, SBI Blue Chip and SBI Magnum Multi Cap Fund. He asks, what could be my corpus after 10 years? One is that question, and I think there is some overlap of the schemes also. Similar
Yes.
categories are there.
Yes, yes. So Sandeep is investing 12,000 per month in these six schemes, and if we assume a post-tax compounded annual return of 13% and his time horizon of 10 years, he would be able to get around 28-29 lakhs at the end of the 10 years. So he would be investing close to 14.5 lakhs, and 10 years from now he would be getting 28-29 lakhs in return. Now coming to the schemes that he has in his portfolio, he has a good mix of multi-cap schemes, mid-cap funds, and also some large cap, but it is skewed a lot towards mid-caps. So just with the intention of balancing the portfolio a little bit, while also not compromising on potential returns, I would recommend that he considers the following changes. He may switch from Aditya Birla Mid-Cap to DSP Mid-Cap. He could switch from SBI Blue Chip to ICICI Blue Chip, and he could switch from Magnum Multi-Cap to a large cap fund like Reliance Large Cap. And he can continue with the other three funds as is, they are good enough. And all of these funds, I should mention, have given a compounded annual return in excess of 16-17% for the last 10 years. So this 28-29 lakhs that we are estimating is based on an assumption of 13% annual compounded return. So he should be able to get that much or maybe even a bit more.
Right. See, it's very important for viewers to remember that the mathematical calculation that our fund advisors are giving is not assured return. Please remember that one. It's a rough estimate if you hold over a period of time. Markets are volatile and the underlying instrument is equity. So at the end of the 10th year, it does not mean that your target of 30 lakhs or 1 crore, whatever target you have, would have been achieved. It could be achieved even before, or it could take even longer, or it might be slightly short of your target. So it's a very important factor that viewers should keep in mind, that if you are looking at a corpus of whatever amount, 50 lakhs, 1 crore, 2 crore in 10 years, 15 years, do remember it's only a calculation and an assumption that we are making over a longer period of time. It's not that the fund advisors or BTVI is going to assure you. Okay. So on that note, let me go to the next caller. Nageshwar Rao is on the line from Hyderabad. Good afternoon, Nageshwar. What's your query?
Yeah, good afternoon, sir. I'm like 50.
Yeah.
I took the voluntary at mine. I have some funds and I wanted to invest into mutual fund.
Okay.
The major reason is actually I wanted to invest into mutual funds with a secure, with a principal outbeat of the returns on FD. So similar kind of funds like so I have some funds into monthly income plan kind of thing. So, but if any better returns with a secure principal, I would like to know.
Okay. Nageshwar, let me tell you first, the chances of assuring that your principal will not be eroded is not possible in mutual funds. That is possible only in fixed deposit, which is why you get a lower return. If you are looking for higher return, it comes with risk. So that is the first principle you should accept if you are investing through mutual funds. Whether you invest in equity mutual funds or balance funds or debt scheme, whichever one you take, your principal will not be assured. It can also get eroded. Or having put that caveat, let me get Mihir to answer.
So thank you, Murli. That's exactly what I was going to tell him, that there are no guaranteed returns in mutual funds, and there is a possibility, and it is quite likely that there will be volatility in the returns over the short term. Now, having said that, if you opt for debt-oriented mutual fund schemes, it should be possible to generate FD beating returns with low volatility if you stay invested for 3 years or more. Now, one thing which Mr. Rao needs to keep in mind is that the point of indexation. In simple terms, what it means is that when you invest in a debt-oriented mutual fund scheme and you stay invested for 3 years, whatever profit you make on that investment is considered as a long-term capital gain, and you have to pay tax on only the inflation-adjusted return. So, let's say he makes 9% on his debt mutual fund portfolio over these 3 years, and the inflation over 3 years is 5%. So, his net return is 4%. He has to pay the 20% tax only on that 4%. So, his post-tax return would be somewhere around 8.20%. This same money, if he invests in a bank FD, let us say it is giving him 7.5%, the entire interest amount that is generated on it would be considered as his income and would be taxed as per his income tax slab. So, if he falls in the 30% tax slab, his post-tax return would be around 5%, and if he falls in the 20% tax slab, then his post-tax return would be around 5.5%. This barely beats inflation. So, while FDs do guarantee the return, but you need to keep this in mind and also consider debt mutual funds. Now, for your purpose, the schemes that I would recommend you take a look at are the Birla Sun Life Credit Risk Fund, ICICI Regular Savings Fund, Reliance Hybrid Bond Fund, Franklin India Dynamic Accrual Fund, and HDFC Corporate Bond Fund. You can divide your money equally into all of these schemes and hold for at least 3 years to get the indexation benefit.
Right. Nageshwar, all the best with your investments, and Mihir, thank you so much for taking our viewers through your expert thoughts on how to invest, which funds to invest, and how long to hold them is a very important piece of information. Save, invest, and prosper, viewers. That's all for this edition of the Mutual Fund Guide. Stay tuned to BTVI for more news and updates on the other side of the break.